According to the 2019 Sanlam Benchmark survey, South Africans are not saving adequately towards their retirement. Further to that, South Africa's group insurance market has reached a tipping point. For many employers, group risk fees rose by upwards of 50% over the past few years as a result of a deterioration in claims experienced across the industry. This has resulted in many South Africans choosing cheaper insurance plans, resulting in devastating losses when claims occur due to being under or not adequately insured. So to tell us a little bit more, we're joined from our Sea Point studios in Cape Town by Viresh Maharaj. He's the Chief Executive of Sanlam Corporate Sales and Marketing. Viresh, thanks so much. Good to have you here on Morning Live.
Oh, it's great to be on, Leanne.
Talk to us about the survey and how has this resulted in some South Africans actually being underinsured?
Well, Leanne, since 1981, Sanlam's been conducting the most comprehensive research into our retirement funding industry. And over the last couple of years, we've seen a worrying trend that group risk premiums have been increasing on the back of deteriorating claims experience. Now, what that means in plain English is that more people have been claiming over the past number of years and have been claiming higher amounts than what had been priced for. Now, the impact of this is that the industry then reprices the insurance premiums, and those premiums have actually been increasing dramatically over the last couple of years.
Yeah.
Now, the net effect of this is that we as consumers are now paying more for insurance, and that means that we are now contributing less on average to our retirement funds.
Which is a frightening thought actually, because for some people in these tough economic times, they do forego insurance. I mean, especially if a car has been paid up, or they feel that they don't really need medical aid because they don't get sick, or perhaps they're too young to even consider retirement. Are these the kind of cases that you're actually seeing?
Well, thankfully, for those of us who are fortunate enough to be part of employers who have a group insurance scheme in place or retirement fund in place, those decisions are to a large extent taken away from the individual and are made at a corporate level or by a board of trustees who have been empowered with experience and education and training to make appropriate decisions for a large number of people that they're responsible for. So even though these rates have been increasing, these employers and trustees have been calibrating their benefit structures to still be appropriate for the majority of the membership that they're responsible for. Now, this is a key difference and benefit of being part of a formal group insurance structure or being part of an employer that offers such benefits. Because as an individual, you are probably not even aware that you're covered, yet you are. So you don't have the opportunity to buy down or to scale down on these benefits. Yeah. So as long as your employer or their nominated board of trustees is able to take appropriate decisions, you are being covered to a large extent. This is important because it enables financial inclusion for a broad spectrum of South Africans who on their own would not have had access to such cover or may have been taking irresponsible financial decisions to kind of scale down.
Yeah, interesting. Let me just talk to another finding in the survey, is that of policy changes and the amended tax treatment of disability income replacement policies, basically meaning
Yes.
that there's little incentive for individuals to return to work. Tell us a bit more about this.
So if we go back to, call it 2015, there was a change to tax legislation where prior to 2015, the insurance premiums that you paid for disability income replacement policies. Now, these are policies that pay an income if you become disabled and are unable to work. You get a monthly income until you're able to return to work, according to the criteria involved. So prior to 2015, those premiums were tax deductible on an annual basis, but the income you received as a claimant, you had to pay tax on that. In 2015, that switched. So the premiums you paid were no longer tax deductible. And the income you received was now tax-free. The actual impact of that is that individuals receiving an insurance benefit stood to earn as much as they did when they were employed, and in some cases even more so. Now, the way that this impacts on the actual insurance experience is that an individual who's able to earn similar to what they did before they became disabled has very little incentive to rehabilitate, to follow the correct regimens, and to apply themselves to actually return to work. Because why do so? You're earning the same as you would have been doing had you been fully employed. It's just that now the insurer is paying your salary. Now, this might sound nice for claimants, but it actually has a knock-on effect on the rest of the membership base who continue to pay those premiums because they now have to pay more as an insurance premium to make up for the deterioration in claims experience as a result of the claimants staying as claimants for far longer.
Okay. This is one that actually frightens me a little bit, because in one of your answers you were saying how people don't even realize that they are being covered and it's a good thing, and we sort of are kind of comfortable in the thought that our company is looking after us. However, this is quite frightening, is that people are actually reporting that there's a trend where smaller companies are not actually paying their share of medical aids or group life cover, and when it comes time to pay, there's a shortfall in funds. This is a very worrying thing.
So it is, and I think it's a function of the economic cycle that we're in, where many employers are finding themselves under significant financial pressure, and they have tended to view their retirement funds or their retirement funding contributions as a factor that can help them to manage costs. Now, by law, they are compelled to pay those contributions through to the retirement fund or to the administrator to deal with appropriately, but we've seen a slight uptick in the number of employers who are holding back on those contributions. And I think there have been some very public cases of that out in the press currently. On the group risk side, you've got to be sure that your employer is actually paying the premium through to the insurer. Because if there's a breakdown in that process, it means that you as an employee will not be covered. It's an intuitive thing. If you don't pay your premiums, then your cover lapses. It's just that in this case, it's the responsibility of the employer or the retirement fund to ensure that they continue to pay those premiums.
Indeed. All right. So, that's something, please, everybody must be very much so aware of. Another issue is that many insurance companies offer lower-end insurance products, and these, of course, are targeted for the bottom of pyramid, as you call it. However, people have to still pay 50 to 70% of a consultation or hospital visit, and also when they have a car or household claim, they find themselves underinsured, and in some cases, the insurance company is also not paying out.
So this sounds like we're talking about more around medical expenses.
Yeah.
Now, in South Africa, there is an ongoing issue around the access to medical coverage. Roughly only 14 to 15% of South Africans have access to private medical care through medical aid schemes, which means that the bulk of South Africans have to rely on the public healthcare service, which over a long period of time has been deteriorating to a large extent. Now, this brings the issue of the National Health Insurance Plan into play. But prior to any implementation, an issue still exists. For those individuals who do pay medical aid and have access to private care, it is becoming apparent that even the benefits provided by medical schemes are no longer adequate to meet the full costs of cover. And this is where a product like gap cover comes into play, because that pays for the difference between what medical aids are willing to pay and what the providers actually charge. The issue is that the majority of members in such schemes actually do not have gap cover, and therefore find themselves going into what's called medical debt. So from their own pockets, they've got to top up for their costs of care. Yeah. And that can become exceptionally expensive.
Oh my gosh.
So the actual issue is you might think that you're covered until something happens, and then you find out at the point that you're most vulnerable and most at risk of not being able to meet those needs, that in fact your cover is not enough.
Yeah, Viresh, thank you. I think this is very important that a lot of people look at these kind of issues and ensure that everything is okay. But thank you for talking to us here on the program. Viresh Maharaj, Chief Executive of Sanlam Corporate Sales and Marketing, talked to us about being underinsured, and when that moment arises where you need it, you think you have it, but you don't, and that's a very big problem.